Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark comments on the lagging Loonie. Real estate consultant Ross Kay believes new federal mortgage regulations in Canada will cause a major depression instantly by taking $1 trillion out of the economy. Seattle real estate lawyer Dan Harris looks at what caused Vancouver's real estate bubble to form and burst. Mackey researchers Payton Nyquvest examines the action on Canada's junior markets. Plus, we'll have a company showcase update with Larry Ray, the CEO of American Manganese, and that'll come up right after the show. We'll talk to Ross Clark right after the break.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
I'm speaking with Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Nice to be with you, Jim.
Canada's employment numbers surprisingly good, and how did that affect the markets?
Well, it was an outsized gain, 67,000, a really nice number. Problem is, you still have got a lot of part-time employment that's part of that package, and a lot of the elderly, I should say those in my bracket, who are picking up jobs on the side here as well. The interesting, overnight the Canadian dollar had been quite weak, been down about 30 points or so, and then the employment numbers came out, had a great jump. It was actually up on the day about 10 or 15 points. But as the day progressed, it really had some terrible action. It just eroded right away down. Now we're talking about levels that we haven't seen in the better part of 4 or 5 months. And when we take a look at how the dollar has reacted in the last couple of months, in particular this last 2 weeks, you've had strong oil market. We've been up just over $50 in terms of the price of oil. You've got lumber trading at the best price in over a year. You've got the base metals, copper, zinc, nickel, this week doing their best levels that we've seen all year long. And the Canadian dollar couldn't get up off the ground. So this type of underperformance, we've seen it maybe 20, 25 times in the last 3 or 4 decades. And invariably, as soon as those other commodities start to just pause, the dollar, it was likely going to give up a quick 2 or 3 cents here.
Gold had a real meltdown this past week. It wasn't just figurative. It really did melt. Yeah,
the catalyst point there was on Tuesday as the price started to give up some ground just through that 1305, 1300 level. And in a very, very short order, we were trading down the better part of $30, gave up the all the way down into the 1240s by the time we had finished off the week. This, when we look back, I'm a technician. That's what I like to do. I like to look at the charts. I look for patterns. And so when we were having that good, strong rally in the spring, we took a look back and said, out of bear markets, what are the classic things that we should look for? Well, it's that 26 to 30 weeks of rally. This was 29 weeks into August. Then you rolled over. You would typically have that 5 to 11 week break. The optimum time was around 7 weeks. So here we are, the 8th week. We've just finished off having the hard break. This is in the miners, not the bullion itself. The miners have really taken it on the nose. And you would expect during this phase that we're into right now, that you would correct a good 30 to 50% of the upside move, and you would also, from the top, end up giving back or declining by a good 25 to 27%. And now we're into exactly that type of position as far as the miners are concerned. Also, at this point, then we'd say, what should we look for to indicate that maybe a bottom is going to come into place? And the relative strength index is one of the things I like to look at. And when I go back and look at the half a dozen examples like this back since the 1970s, when the RSI gets down below 30, which is what it did on Thursday's close, on the GDX, the XAU, and the HUI, the three main indices of the senior miners, that ends up being an interim low. And so as we move forward now, we'll look to see if these can have a minor bounce, maybe making back about half of the decline from the September high, because we've come down in a few stages here. That last high in September, when it had a bounce, we can be looking for us to rally back, maybe close to half of that, come back and retest whatever supports we're going to be putting in right now, and if it can turn the corner through that subsequent resistance level, and that could be anywhere from maybe a few weeks to a month and a half from now. If it can turn that corner, then the probability of it being able to take out this year's high becomes very, very good.
Ross, have yourself a great Thanksgiving.
I do plan on it, Jim. Thank you.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you need to contact him, his email is ross.clark@cibc.ca. Coming up next, Ross Kay on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
We're speaking with real estate consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to This Week in Money, Ross.
Thanks a lot, Jim.
September home sales for homes in Vancouver and the Fraser Valley were released this week. What are the real numbers for September, and what do you see going forward?
Well, if you monitor the market the way we do, which is why in May we were able to come into your show and forecast August's collapse of the market. Or I think I didn't say collapse. I think what the term is, you would go negative in August. The market currently today is around 56% slower than what it was in February and March. Now, that is not a seasonal adjusted number. That is a number of market speed, velocity. So the market has collapsed totally, and as it had last month, and it has collapsed even a little bit further. But the historical collapse was the one that took place last month. We're just sustaining the path right now in Vancouver.
What are the real numbers for September?
The real numbers for September, you're looking at. Well, you see, we look at it on a different basis. We look at it on a yearly basis, which right now you're down around 29,000 unit sales would be forecast. In February, I think we were around 56,000. So that's the type of number that we look at. The monthly sales numbers that the real estate boards release, as I've told you several times here in the show, we don't use those because of the way that they're calculated. They're not calculated to represent the month that they're being reported in. So if you look at we call it the trading rate, as a matter of fact. That's the rate how we calculate numbers. You're looking at around 20. I think it's around 27,000 right now. That's what you're down to.
Now, of course, we have new legislation coming in from the federal government concerning mortgages, and we'll take a look at that. But what about sales in the Okanagan and Vancouver Island markets?
Well, that's good, because as you watch this month, I'm sure I don't know if they've been reporting it on the news correctly or not, but of course Fraser Valley collapsed this market exactly as how we forecasted on your last show what was going to happen. Okanagan has also entered its correction, and I think most of the Okanagan residents will be surprised to hear that. But even though there were more sales reported this September over the previous September, the pace of sales, which again is the number that we use to know whether or not a market is correcting or not, has dropped below the threshold. So Okanagan now is correcting, and you're going to see price movement falls in line, a similar pattern to what we're watching in Vancouver and Fraser Valley. Vancouver Island, on the other hand, it still hasn't started to correct yet, which again is something that we forecast. It will probably begin correcting in when they release their November numbers. It probably will be still stay positive, we think, in October once those numbers get released, but in November it will be negative as well. Province-wide, Vancouver is now in a correction, and it has, British Columbia is in a correction, and it is following the path exactly as all housing markets do.
What's happening in the Calgary and Toronto markets?
Calgary market, as again, I hate to keep going back to this, but as we forecasted, we're the only people in Canada who forecast with this kind of accuracy. But again, I stress it's not genius or anything of that nature. It's just that we know how to read a real estate market, and we know how to read real estate data for what it says. So Calgary did exactly what we had forecast that it would do this month, in particular, in the month of September, and that is that it is flatline. So Calgary has now reached its trough. At the trough is when you start to see your housing price, the average selling price starts to decrease at a rapid rate as first-time buyers begin to re-enter the market. But of course, everyone's lulled into a false sense of happiness right now because the real estate board says sales are no longer falling. The market, it seems to have plateaued, and housing prices they're going to say the average selling price is up between 6 and 7%. The underlying fact is that we have wealthy homeowner members that are out in Calgary right now who are paying 35% less than what they would have paid for a house in the exact same house back in 2014. So their market is plateaued in the trough of their brand new trading cycle, which will begin soon as first-time buyers start re-entering the market. And at that time, the average selling price would normally start to drop. But of course, we had a change to the world of Canadian real estate this week.
What about the Toronto market in particular? Okay,
so the Toronto market, the outer rings of the GTA. So what your listeners in Vancouver or in British Columbia should listen to here is that the GTA has 1.5 million owner-occupied homes, which is the exact same number of homes that exist in British Columbia. They are virtually identical, within 100,000 of each other. The province of British Columbia has about 1.5 million owner-occupied homes, and the GTA in Ontario has 1.5 million owner-occupied homes. The GTA market has followed the exact same pattern, the exact same increase, the exact same prices as British Columbia has followed. So the selling price in May, the average selling price in May of 2013 in British Columbia, and the average selling price in May of 2013 in the GTA was exactly the same. And now, we're 37 months later, their selling prices are again exactly the same. All real estate markets move in the exact same pattern. It cannot be avoided. So the Toronto market had a surge here this month. Now, it's predicated on, again, the way that they calculate real estate data. So I'm not going to get into that discussion. But it had its probable final surge. Now, it may have continued on for another month or two, but again, this week happened.
Is the tightening of mortgage regulations by the Trudeau government a black swan event and how much paper wealth has been lost in BC and the rest of Canada as a result?
What happened this week? What happened this week will go down in history as I'm going to use the word stupid. The stupidest move by a political party in Canadian history. What the federal government of Canada has just done, they have let the BC Liberals off the hook. Because what's going to happen in the next 2 weeks and going forward after that period is going to eliminate any suggestion that the correction has anything to do with the 15% housing foreign buyer tax being put on in British Columbia. They've also let the realtors off, not only in Vancouver, but also in Ontario, where all of the bad data has been misrepresented to the public for over 3 years. They've let all those people off the hook. The reason they've let them off the hook is Canada is now sitting in a situation where on the 17th of October, or the 16th of October for the sake of the argument, you could purchase a home in Canada on a 39% GDS of the current market of whatever your income is. On October the 18th, I'm going to give a day's grace here. We're going to give 48 hours. On October the 18th, you will only be able to use 28% of your income to purchase a home. What they have effectively done is, if you've listened to every housing speculator, every housing so-called expert, every economist from across the world who's commented about the housing market, they have said that the only thing that's going to change the housing market will be an interest rate rise. Well, I know that's not true, but what's going to happen is you're going to have a false assumption that these guys' theories are correct. Because what we're going to be seeing is an effective 2.5% interest rate increase in 24 hours. That is the single quickest interest rate increase in the history of North America. What the government is doing is there's on the 16th of October, you could qualify on a 5-year mortgage rate of 2.17% to purchase a home. Now, we're not talking about first-time buyers here. We're talking about trade-up buyers, the people who already have skin in the game, the people who have already paid off 7 to 8 years of their mortgage. All of a sudden, the government is telling them that 2.17% interest rate you qualified for on the 16th is no longer applicable. You must now qualify with a 4.64% interest rate. What this effectively does, Jim, is it effectively lowers the buying power of the consumer, the person who purchases the current homeowner who's trading up their home to buy the average home in Canada that's being sold by 21%. It is impossible for the person who's purchasing a $703,000 home, which is the average selling price in British Columbia as we speak. It is impossible for that person to purchase that home and pay $703,000 on October the 18th. On October the 16th, if you earn $75,000, you have $200,000 down, you purchase the average home in British Columbia, the government would say it's okay. On October the 18th, if you still earn $45,000, you still have $200,000 down, the government's going to say, whoop, hold on. You can only buy a house that's $550,000. Homes selling prices are totally contingent upon the amount of down payment or equity that you have and the amount of mortgage the government will allow you to carry. What that means, Jim, is we are looking at a 21% house price correction overnight. The government clearly had no concept of what the unintended consequences are of a decision that they have just made. The consequences are far, far more greater reaching than this drop in house values alone. We are talking about nationally over a $1 trillion loss in net worth. Anybody who does not assume you go from $703,000 worth of buying power down to $550,000 worth of buying power, that home prices are not going to plummet. Because if you look at a historical perspective, housing prices simply rise and fall with interest rates. The problem Canada has is interest rates have fallen since the 1980s. What's going to happen on October the 18th is that $703,000 home in British Columbia, the average selling price of a home in British Columbia, you're going to, even if you still have the same $200,000 down payment, you are going to have to go from previously only having to earn $75,000 to having to earn over $103,000. This goes across Canada in the exact same way. The income is not there to support these higher selling prices any longer. We have already gone through a 37-month housing cycle, trading cycle in this country, where fewer and fewer buyers are able to buy a home. So even though you've seen increased sales, the sales numbers are still relatively so low that what the increase happens to be for those people who can afford to buy another home at these higher prices. In other words, the income level kept having to increase. $75,000 is basically the break-even point on a housing market in Canada as of 2016. Once you're asking the population, in other words, you're relying on people with an income of over $75,000 for the housing market to be sustained, that does not work. The numbers just are not there. So what the government has done is they have unknowingly, because they don't know how to read the real estate data, they don't even know how to understand and read CMHC data or the Bank of Canada mortgage data released by the banks. They don't understand how that works in a real estate market. We do. We know exactly how the average selling price of a home is set. We know how people pay for it. We know what amount of equity they use, and we know what amount of financing they use. We know that that has been the same from 1985 till 2016. It has never changed. It never will. What will change is that we have a full-blown national crisis on our hands that on October the 18th will begin to hit home.
How exposed are the lenders, and were these new regulations brought in due to CMHC nearing its lending limit?
No, the rules were not brought in for that reason. Now, this is a bit more of a complicated topic because it covers other areas that we don't normally talk about on the show. The government clearly, and I mean this in all sincerity, they have no idea what they're doing here. They actually believe there's such thing as cooling a housing market. They actually believe you can cool a housing market. What I would ask is, if you can cool a housing market, please supply me one single cooling of a market in the history of Canadian real estate. And what I'll tell you is, it doesn't exist. What exists is an upswing in the market and a downswing. There is never a level playing field. There is never a softening. There is never a cooling. A market corrects or a market doesn't correct. It continues to escalate until the math no longer works. A correction is required to get the math back in line.
Ross, is this new mortgage stress test likely to become tougher?
Are you asking me, will they increase the stress test even further?
Yes.
No. They have done something that has never been that has never done in any country in the world, as far as to the best of my knowledge. They have increased interest rates, the qualifying rate, by 2.5% over 24 hours. That's what they're going to do. If they want to cut even more buyers out of the market, then we're talking even a greater recession or depression. I personally believe the removal of $1 trillion of net worth, which is what happens on a 21% house price correction, is going to send this country into a full-blown depression. That's what I think.
When it comes to real estate, are governments proactive or reactive, and could this cause Trudeau to be a one-term prime minister?
Unfortunately, governments are reactive to political pressure. In the case of housing, they do not step back and logically look at this on a way a housing market functions. As I've said in your show over and over again, the problem there is how a housing market functions is not taught to any economist at a post-secondary level. It's going to take this national devastation of net worth for people to understand you cannot trust an economist who has never been trained in how a housing market functions. The government has just decided that they're going to let the conservatives who were in power for the previous 7 years, who used the housing market to stave off the Great Recession in Canada. In other words, Flaherty modulated the policies so that Canadians would borrow money against their homes, which would fuel further house price growth, which naturally allows more lending to go on. So it's a self-fulfilling prophecy for the sake of the argument. Mortgage lending and your debt to GDP ratio have aligned 100% since 1990 forward. There is no confusion about this. If you know how to read how a market's functioning, you can see these numbers. What the government has said is, the conservatives, you're now off the hook. We're going to take the blame for what's going to start happening on the 18th of October. Every single one of your listeners who are listening to this show have to sit down with a calculator today, look at their own situation, go to a mortgage amortization chart, and see what happens if the government told you could only continue to own your home if you earned enough money to cover your mortgage at these higher interest rates. That moment, the second they check that mortgage calculator, the reality of what the government did this week is going to hit home. Barring the government reversing this policy, Canada will have entered a period of correction that is going to be, it is something even my firm can't predict. It is because there is no historical comparison available. The American correction of the Great Recession, that was totally predictable, totally worked out the way that a correction was going to work out, even with all the problems with their banking system. This is a totally different phenomenon. This is an interest rate rise of 2.5% in 24 hours.
What effect will these changes have on the reverse mortgage market?
Well, this is what, there was an article the other day by someone in the Globe and Mail, a retirement specialist or something of that nature, talking about how there is no risk in to the lender or to the borrower in a reverse mortgage. Well, clearly he's never read the contract and applied what the outcomes in the contract potentially could be. And clearly the Minister of Finance, when he set this rule, did not do that. They will allow you to borrow, in most parts of Canada, around 45% of the value of your house as a reverse mortgage, promising that you will never have to repay it. What people don't understand is, in those contracts are provisions that you must maintain, replace, renovate, keep your house at its current market value. Those provisions are in there to offset the potential of a market correction hurting the reverse mortgage holder. So what you're going to see is you're going to see these people who have gone out and reversed mortgaged at the full 45%. The housing market is going to correct a minimum of 21% now you're looking at, let alone, I mean, it's just a spiral down. When I talk 21%, this is only the tipping point. That's just when it turns over. It's going to spiral downward. There is no stopping this. There are no income gains. The government's going to have to reverse this policy to stop the damage from being done one way or another. Reverse mortgages, if you're in one of those, in those market conditions, the lender will act to protect themselves. Unless you're covering your butt on every single one of those clauses you forgot to read over when you signed up for that reverse mortgage, you're going to find the lender saying, oh, hey, wait a second, you're not meeting that obligation. I'm sorry, either you come up with the rest of the money or you're going to have to move out.
Are basement suites going to become scarce due to the government's new regulations?
Of course. These rules are already in place. If you rent out a basement suite and you claim expenses to offset the income, that automatically made that property taxable. But in the past, the government didn't care because I guess they just didn't have enough staff to research it. What the government has done this week, the same thing that they did in 9/11, when all of a sudden there were new powers given to the police to investigate regular Canadians. What they have done is they have used a foreign buyer myth, because across Canada we're talking less than 2% of the market at the worst case scenario, 2%, and I know it's not even close to that. They've used that excuse to justify asking every Canadian, for the first time in history, veterans who went into the war, fought for this country, who paid for their houses for 50, 60 years, are now going to have to self-claim on their income tax form that they sold their principal residence. They have lived in this country, they have owned their home this entire period of time, and they have owned it under the assumption they never had to pay capital gains on their personal house. What's happening now is the government says, wait a second, we're going to check on you. They're not checking on anybody. They're not checking on people for foreign buyers. That is a clear misleading of what's going on. What the government is doing is they are building a database for everybody who moves so that they can track you. And then 30 years from now, when there's pressure on the pension plan, the government pension plan, they're going to be able to look at your net wealth that's tied up in your house, and they're going to be able to make a judgment call. They can literally be in a position to be able to force you to sell your home because they say you're worth $1 million now. What do you mean you don't have any income and you want government pension? You've got $1 million sitting in your home. We're demanding that you sell your home instead of taking the pension. That's what was the really sneaky thing that was done today. Whether the government was competent enough to understand that's what they did, I don't know. But what I do know is that is a consequence of you having to report something that has been a legal right of every Canadian in this country forever.
Ross, thank you so much for chatting with us, and I'm sure we'll be talking soon about these measures.
Thanks a lot. Have a good day.
My guest has been real estate consultant Ross Kay from thewealthyhomeowner.ca. Coming up, Seattle real estate lawyer Dan Harris next on This Week in Money.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Dan Harris. He's a corporate lawyer with Harris Moore in Seattle. He runs the China Law Blog online at ChinaLawBlog.com. Dan, welcome to This Week in Money.
Thank you. Glad to be here.
We're looking at what caused the real estate bubble in Vancouver, BC, and what's causing it to burst. Now, we know that China restricts cash leaving China to $50,000 US per person per year, yet somehow that money seems to be getting out. And over the past few years, luxury and ultra-luxury real estate in a number of cities around the world has been purchased by Chinese nationals. This created the real estate bubble. Now, we're wondering, how long is this bubble going to last, and how were the Chinese able to get the money out of their home country to buy this high-end real estate?
Well, there are a lot of answers to that question. And the reason there are a lot of answers to that question is because there were a lot of ways Chinese nationals were able to get their money out of China, most of the time illegally. China limits its nationals to taking out only $50,000 US dollars per year per person, but there have been a lot of techniques employed to go beyond that $50,000 figure. But earlier this year, China started putting a priority on cracking down on those various methods. And even though it is not succeeding 100%, it is definitely getting a lot harder for Chinese nationals to get their money out.
I know a lot of countries do have restrictions on cash movement. How successful are they at controlling that cash?
Usually not very successful. And one of the reasons they're usually not very successful is because every country, especially a country like China, needs to do business with other countries. And so when China limits money leaving China, it generally limits it to people, not businesses. And right there you can see a way to get money out. So for example, you might have a company in China that buys $10 million worth of factory equipment from the United States and Germany every year, and maybe one year they'll just increase it to $14 million, but still really only buy $10 million worth of factory equipment. And their friends in the U.S. or Germany from whom they buy the factory equipment will hold that $4 million and put it in a U.S. or German or a Canadian bank account in favor of the Chinese national. And that money looks to the Chinese government like it left 100% legally and was used for international business purposes, but in reality, that $4 million left over is used to buy a really nice condo in Vancouver.
According to Ross Cave from the wealthyhomeowner.ca, Vancouver Real Estate topped back in February. Now, did Chinese regulations concerning the moving of money happen at the same time?
No. Chinese regulations have not changed. What has changed is China's desire or even enthusiasm for stopping illegal money transfers. So whereas 2 years ago, a Chinese company would decide to buy a Canadian company for $5 million in a scam transaction just to move $5 million over to Canada, now China's looking very closely at those sorts of deals. So, for example, I believe it was in March or so, our firm got a call from a U.S. company that was supposed to get millions of dollars in investment from a Chinese company, and the Chinese government was holding it up, and it looked to us like the reason the Chinese government was holding it up was because many owners of the U.S. company were ethnic Chinese, and that led China to believe that the whole deal was a scam being used to move money out of China illegally. and so they held it up. 2 years ago, that never would have happened, and we're getting a lot more of that. So China is just really looking closely at every deal. And so let's take the example of the company that was buying $10 million worth of equipment. Now they're buying $14 million, trying to hide $4 million in a bank account in Canada, let's say. The Chinese government is going to look very closely to make sure that $14 million worth of equipment actually goes back into China. And if it doesn't, somebody's going to be in big trouble. The Chinese nationals now know this, and so they're being a lot more careful. And what this all means is that less money is getting out to do things like buy houses.
Will China put pressure on people to repatriate the money they have spent on real estate in North America?
Well, that's happening too, and that is really happening. And where it's happening because China is going after people who not only have repatriated money from China. I shouldn't even use the word repatriate because I think means that they're replacing it or putting it back. But the Chinese government is not only going after people who have sent money out of China illegally, but they're really going after people who have earned that money in China illegally, meaning government officials who took bribes. China has mounted one of its strongest anti-corruption campaigns, and that's been going on for a while now, and they are taking those campaigns to foreign countries like Canada and the United States and going after money earned illegally, money and property.
Well, we have seen that in Vancouver where the Chinese government wants the money back from a $14 million house they said was acquired through illegal money.
Yes, and it's happening in the U.S. as well, and it's going to keep happening because governments like nothing more than spending $500,000 and getting $14 million. Everybody likes that. It makes them look good on a lot of levels.
Does shadow banking exist in China, and what role does it play?
Well, shadow banking is huge in China because it is very difficult for most people and most businesses to get large sums of money in loans. The banks in China are mostly set up for the state-owned enterprises. So shadow banking is rampant in China. How that impacts money leaving China is not so clear. These banks will loan money to someone who's trying to get money out of China. One of the things they sometimes do is loan the money in such a way as to allow the recipient to get the money in another country. And they can do that through banking relationships. How prevalent that is and how much that impacts real estate and or even how much China is cracking down on that, I don't really know. I'm going to assume that China is cracking down on that simply because they're cracking down on every method they can to try to prevent capital, try to prevent foreign currency from leaving China.
Does China itself have several real estate bubbles brewing?
Well, I'm not going to claim to be an expert on China real estate pricing, especially since I've thought most real estate in China has been in bubble territory for years and years and years, and I just keep waiting for it to pop. So I guess my answer is I see it as a bubble. Will it pop tomorrow? Will it pop 10 years from now, 5 years from now? I don't know. I don't know if anyone really knows. But you definitely see some crazy situations in China where a new project or new development goes up for sale in a city where real estate is hot, and it can sell out in hours. Hundreds of condos can sell in literally hours. And to me, that's a sign of a bubble.
If the real estate bubble in China bursts, will that cause the Chinese to sell their real estate holdings in other countries to cover their losses?
I am sure that it will. It's human nature. If people no longer can tap their real estate in China, and they in effect become a lot poorer in China and need more money to maintain their existing lifestyle in China, yes, I could absolutely see sales of foreign properties by Chinese nationals increase. And more importantly, I could see sales of or buying of foreign property decline by foreign nationals decline even more, simply because people don't feel like they have the excess money they had previously to go off and buy that nice condo in Vancouver.
Dan, thank you so much for being on This Week in Money.
Thank you.
My guest has been Dan Harris, a corporate lawyer with Harris Moore in Seattle. His online site, ChinaLawBlog.com. Coming up, Payton Nyquvest next on This Week in Money.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Payton Nyquvest. He's an investment advisor at MackeyResearch.com. Payton, what happened on the Canadian junior markets this past week, especially with a meltdown in gold and silver?
The TSX had a high of 14,731. Low was around 14,472, closing at 14,565 for the week. So for the week, it's down about 166 points. The TSX Venture had a high of around 800. Low was 765, closing at 780. So it was down about 20 points. And the CSC had a high of 797. Low was 730, and closing around 786. So it was actually up 11 points for the week.
Now, that's kind of surprising considering what happened in the gold and silver markets, isn't it?
Yeah, you know, the juniors seem to be quite resilient to the fluctuating gold price. You know, gold was off quite a lot, but for the most part, the juniors were either off a little bit or flat, which is good to see. It's good to see that they're continuing to stand here and continue on operating. So, you know, I think the gold price obviously a bit washy here for the next little bit. You've got an election coming up, you've got Christmas coming up, tax time, so it'll be an interesting couple of months probably.
Now, I've noticed a trend as well. Even when the senior markets are down for the day, the venture exchange still somehow manages to keep its head above water. Why is that?
Well, you know, the venture, it's easy to look at a one-year chart and say that. It's a little tougher when you look at a 5 or 6 year chart. You know, the big boards had their fun, and the venture's definitely well overdue. So I think there's a bit of resiliency there. You know, also if you look at a lot of these marijuana stocks, which we're now talking about again, they have all been skyrocketing for the last little bit. You know, even leaders like Canopy Growth has gone from, you know, a couple bucks now pushing north of $5, and so you're having a lot of stocks that have really kind of exploded in the marijuana space over the last little bit.
Is this something that Canadian traders have to be aware of, because marijuana being a legal product is brand new for most people?
You know, it's a new industry. There's been a lot of press about legalization and what kind of the plans are in Canada around that. So I think that's where a lot of the attention is coming from. And, you know, obviously you're getting a lot of Americans who have seen a lot of success in legal marijuana down there are now looking for opportunities, and Canada's kind of looking like it's going to be the next opportunity in legalization of marijuana.
Well, I know states that legalized it, places like Washington State and Oregon, they had such a rush on the product they couldn't keep the store shelves stocked.
Yeah, you know, it's very interesting. You look at down in Colorado, they've had the same problem where it's just been flying off the shelf, and you know, some of the tricky parts, obviously, which we've talked about a little bit, having to operate in cash because they've had problems with banks kind of coming in and supporting them and letting them open bank accounts. But, you know, that'll all happen as this continues to grow, obviously.
Payton, thank you so much for chatting with us.
Thanks for having me.
My guest has been Payton Nyquvest, investment advisor at MackeyResearch.com. That wraps up our show for this week. We'd like to thank our guests Ross Clark, Ross Kay, Dan Harris, and Payton Nyquvest, and thank you for listening. Any questions for This Week in Money can be emailed to info@howstreet.com. Coming up right after this show, Company Showcase Update with Larry Reaugh, CEO of American Manganese. I'm Jim Goddard. Happy Thanksgiving, everybody. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
We're chatting with American Manganese CEO and President Larry Reaugh. Larry, there's an update to the information you gave us the last time you were here on Showcase. What has happened since September 17th?
Well, I'm glad that you've asked that question, Jim. Yes, there is. There's a couple things that have changed. We've come out with some news, but I'd like to just first off just discuss this market right now, because we did touch on it briefly on the last interview, and that was how these shorters make their money and drive these companies down. And we've seen a lot of that in the last week or so. It's not just with American Manganese, but with other companies. This is a perfect climate for them to really get in there and bash these companies and make money doing so. And because you've got a general market that's down, and there's a lot of skepticism and a lot of nervousness in the market, so this is how they thrive. That said and done, we've had some good news. Certainly, everything that we've done, and the latest press release is, which was October the 4th, we talked about the proof of concept work nearing completion, and the only thing we have to finish off is the actual building of the batteries, and there should be that should be taking place in the next week or two, or maybe 2 or 3 weeks. It's hard to get the timing on that, and that'll be the proof of concept behind us. And we've approved a second lithium cobalt recycling research program, and that has been approved, and that's expected to start by the mid-month. And which is October the 15th. So, we are certainly very happy with what we've got. We've got a lot of interest outside of the market from various groups, and that really are very interested in what we're doing. And I couldn't be happier, Jim.
And anything else, Larry?
Well, the putting out the good news on a bad market is always brings in buying, and it also brings in the shorters, because they need that buying to short to, and that's always an unfortunate part of the business. But when you have a good product and you just stay your way, there shouldn't be any panic out there, and we will, eventually this recycling thing will come to fruition.
Is it good news for lithium that the government of Canada plans to drastically hike carbon taxes over the next few years? So I think they're trying to push people into electrics.
Well, that'll certainly happen. If they go through with this, it's going to be a real burden on the taxpayers, but it will also give them guys that have been on the fence will say, well, I'm going to electric, right? I'm not going to be paying this carbon tax. And that, will certainly boost the business. And that's in Canada, that's not as significant as, say, if it was the U.S. or China that was doing it. But it's a good start, and if Canada is doing it, you can bet that every other country will be looking at it.
Larry, thanks a lot for updating your file.
Well, thank you.
And for those of you who didn't get a chance to hear the original interview I did with Larry back on September 17th, here is the original showcase interview. Larry, what can you tell us about your company, American Manganese?
Well, I can tell you our company is now focused on quite a different set of parameters than we were here a year ago. And those parameters are on the recycling of lithium-ion batteries. And, Jim, I have to say that we were fortunate that the company was able to look within itself for organic growth. And what we found, or what Chemetco found for us, was that our process that we developed to liberate manganese from low-grade ore deposits in the United States was suitable, and this is a patented process, by the way, was suitable for recycling and upcycling of lithium-ion batteries. And the more we studied it, Chemetco was very convinced that we should be able to successfully do this. So we said, okay, what do we need next? And we needed a proof of concept. So we started that a few months ago, and Chemetco came out with the first phase of the process, which was to leach the cathode material, which happened to be lithium and cobalt, and they extracted 100% of that material. Now, it was in solution, so our next phase was to precipitate it, and we just announced today that was a successful effort. We got out of the first cycle, we got out 60% of the lithium and 91% of the cobalt. And I'd like to just kind of interrupt the flow here by saying that when you're looking at the economics of a recycling program, you wonder where the money is. Certainly the money's in the lithium cobalt, but it leans more heavily to cobalt because a lithium-ion battery contains 60% cobalt and 4% lithium. And so you can see where I'm going with that. The battery has much more cobalt in it, which trades at about $12 a pound. And currently lithium's trading at $8 a pound. So that's looking at the economics of the situation. But we don't want to take our focus strictly on economics. We also want to have this as an environmentally friendly process. We want it to have as a circular economy where you wouldn't have to open new mines in the years to come to supply cobalt and lithium to the battery industry. And it has no waste products, so the recycling plant could be set up in for example, an industrial park in the Lower Mainland here, or in Los Angeles, New York, or wherever or Shanghai, wherever you had a inflow of lithium-ion batteries there. The batteries are starting to reach the end of life. There was 282,000 batteries that reached their end of life last year. That number will grow to over 500,000 by 2020. And then I don't know what the numbers will be after that, but it'll eventually be in the millions of batteries a year. And so you want to have a efficient and a environmentally friendly green process in order to recycle those items. So we think that we're on the right track. And to give you an example, the press release that we put out on August the 4th got the market excited about what we were doing, and we traded up until yesterday around 110 million shares in just over a month, and then today we traded about 10 million shares. Unfortunately, we still have that problem of shorting going on, and it was pretty obvious to anybody watching the market that we were getting heavily shorted. And that's a combination of, actually not just a combination, it's the fact that the market's dipped quite dramatically today, and they took down a lot of stocks, and this is when the short players, the predators, come out and they pounce on a stock, and they can take good news and turn it into bad news in a heck of a hurry. And that's probably what happened today, and that's strictly speculation on my part. I've been studying this issue for a long time, and I've seen it repeat itself over and over and over again, not necessarily in AMY, but in a lot of other stocks that I follow out there. So that's one of the things that we're up against, but we think that we have a product that will overcome. And that product is, what we're working on at this current time. Now, Jim, when I was back, I broke this conversation off at where we announced the precipitation tests today. And I'd like to point out that that was a first-pass precipitation test, so we got 60% of the lithium, 91% of the cobalt. But if we lock cycle it, which means we cycle it a few more times, we can get much higher recoveries, and that'll be work that's going to be ongoing. And so we'll have an update to this at some time in the future. I can't exactly guess because there's a lot of assay and outside work that has to be done by the research lab in order to get those results. But I'd hope in a few weeks that we could update everybody on the precipitation tests, and then we're definitely going to move ahead on our. We've got enough powder to to start our testing for rechargeable lithium-ion batteries, and we should be able to start working on that in the next few days, and hopefully we'll have some news in a few weeks coming on that. So the company is, it's progressing, and we are happy to say that we haven't hit anything that's a major roadblock, and that we're striding ahead. We don't know of anybody else that's doing this because it is not a transparent business. So, the company is trying with all due diligence to get this out as quickly as possible so we can move on to the next stage. And that next stage, of course, would be looking at the at pilot plant testing and commercializing the process. And by commercializing, I mean we'd have a much larger pilot plant test than we did with our initial manganese testing back in 2010 and 2011. And that would entail a larger plant because we want to produce a ton or two of material in order to basically to make the powder available to battery manufacturers. And so that is going to be another step, and that'll probably start sometime early next year. Now, lithium-ion batteries are in the news. Lithium's in the news. Cobalt is starting to be in the news. We know there's shortages coming in both of those products, and we hope to be able to supply some of the answers for those shortages. And this doesn't just stop at lithium cobalt. We'll also be, sometime in the near future, we'll be looking at other combinations like nickel, manganese, cobalt, lithium, nickel, manganese, cobalt batteries, and we'll be looking at separating those cathode materials out and producing a powder that could be used back in that type of a chemistry. So we really have a tiger by the tail here, and just to keep up with everything is, it's a fun project. Now, I know I've been kind of on a ramble here, but I'm trying to fill in the gaps as much as I can, and let you know that management and Chemical Research are pushing ahead diligently to make all this happen. We're starting to get some outside interest. We probably will be looking at some government grants that could be significant in the pilot plant stage. And we actually believe that we will be funded partially through grants and partially through equity or partnerships or something like that, because it really opens up the door. And that door is, what do you do going forward? I think at a certain point, after all of the proof of concept is completed, that we will have end up with a partner. That's speculation at this point, but being in the business for a long time, if you've got something that everybody likes, and it generally results in having a partnership somewhere along the line, or licensing agreements, or sales of royalties, or anything like that that will help fund the company besides equity. But equity is always one way to go, especially if you've got grants to supplement that. And so we're encouraged that everything's falling into place the way we envisioned it, and we would hope that at the end of the day that we're successful. Now, another aspect to look at is, cobalt is in danger of being in demand with little supply, and that could happen as early as the end of this year, according to all the other pundits out there. But, I can't see any argument against that. And in reality, the cobalt market could explode. And, rising prices don't mean rising supply. Not immediately. That could take years. And it's certainly not going to come from a byproduct producer who and byproducts, by the way, produce about 96% of all the cobalt. Primary is only about 4 or 5%. I think those numbers are correct, but I'm probably within a few points. And so it's got to come from somewhere. So, I could envision the company being a primary cobalt producer somewhere down the road. This might be a few years from now, but certainly would be somewhere down the road. And I think that we've got everything that we need to move this ahead. So we're looking at being a primary producer of cobalt, being definitely one of the producers of lithium, and perhaps in a smaller way nickel and manganese. And the vista's wide open. We could be testing for aluminum, vanadium, depending on the chemistries. And but we're not, we don't have any intelligence on that, so that's just a speculative glance into the future. So when you look at it, you say, okay, here's a company that's a mining company, and right now they've got a product that the commodity price is way down on. I think the last time I looked at the price, it was around 80 cents a pound for EMM, maybe similar prices for EMD, and that's not conducive to ever go into production with our low-grade deposits in Arizona. We need better prices, and we need better times for that. So the company is, reached into its arsenal, and we're very fortunate in Chemetco recognizing the other application here, which is the upcycling and recycling of batteries. So we're not getting out of the mining business. We're just saying, okay, there's no money for it. Nobody wants to put money into it, so we'll hold on to some of the resources that we have in Arizona. We've dropped most of those, but nobody really can treat the low-grade ores unless they have our process. And so we got enough down there that would, be enough to start an operation, but which is reasonable to handle the costs of maintaining every year. And so we'll keep hang on to the manganese, and we'll also hang on to our higher grade gold and copper and silver project up in the Rocheux de Boule area out of New Hazelton. So we're hanging on to our mining assets. That does bring up the question of, well, maybe we should separate the two, and that's something that we're looking at. And but we have to, before we make the separation, let's be totally 100% sure on our recycling, upcycling, and then we can look at what we're going to do to spin out maybe two companies out of this. And but other than today, which was a bad day in the market for everybody, I think the way to look at this project is that it does have legs, and we will advance in the future. But I'm confident that we're doing the right thing, and I think the shareholders like it.
Larry, is there a website people can go to get more information?
Yes, our website is AmericanManganeseInc.com, and I can be reached at 778-574-4444, and my email address is lreaugh, R-E-A-U-G-H, at AMY, mothernorman.com.
Push people into electrics.
Well, that'll certainly happen. If they go through with this, it's going to be a real burden on the taxpayers, but it will also give them guys that have been on the fence will say, well, I'm going to electric, right? I'm not going to be paying this carbon tax, and that, will certainly boost the business. And that's in Canada. That's not as significant as, say, if it was the U.S. or China that was doing it. But it's a good start, and if Canada is doing it, you can bet that every other country will be looking at it.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. This has been a HowStreet.com radio company showcase. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.